In February, the market called this bill an 82% lock, today 37%, and not one senator has voted. Three things today. 1. Why a bill everyone says needs 7 Democrats actually needs 10. 2. The $908 million contract expiring in 3 weeks that nobody is watching. 3. Whether a market priced for failure has left the upside on the table. By the end, you'll know exactly what to watch and what would prove us wrong. Welcome back to Wall Street Holic, where we cut through the market noise and deliver sharp, data-driven insights without the hype, bias, or distractions. Just clear facts, deep research, and actionable analysis to help you make smarter investment decisions. Every insight is backed by real data, and if you want to dive even deeper, you can download the full research-packed report using the link in the description below. Housekeeping. Total crypto market cap is $2.27 trillion as of the 26th of July 2026, down 42% in a year. And nothing here is personal advice. Before any arguments, I want you to read one screen in color. Here's the whole topic on one screen. Green for tailwind, red for headwind. And it's mostly red. The market being regulated has shrunk 42% in a year. Spot Bitcoin ETFs are bleeding cash for the first time ever. Passage odds have collapsed from 82% to 37%. But look at the green holding on. Stablecoins still compounding. USDC volume up 263%. Coinbase taking record share. The politics are deteriorating. The underlying business quietly is not. And the whole thesis lives inside that contradiction. So, let's start where nearly every headline goes wrong. The maths of 60 votes. Republicans hold 53 seats and cloture needs 60, cloture being the Senate's 60-vote motion to end debate. No 60, no final vote. The press says find 7 Democrats. Wrong. Galaxy's 24th of July note expects Hawley and Paul to vote no, and McConnell hasn't voted since a June hospitalization, putting the reliable base near 50. That means 10 Democrats. Only 7 are even negotiating. Murphy, Van Hollen, and Merkley have declared against, and Warren filed 44 amendments. Sweep the whole table, and you're still 3 short. That's the arithmetic. Now, why does anyone bother fighting it? Because the prize is huge, a $2.27 trillion market handed to a $365 million regulator. So the investable question isn't whether it passes, but who collects the tolls either way. Clarity splits the job. The CFTC takes spot markets in digital commodities like Bitcoin and Ether. The SEC keeps genuine investment contracts. The first purpose-built US framework since the 1933 and 1934 Acts. The House passed it 294 to 134 a year ago. Senate banking cleared it in May, and it has sat on the calendar 55 days now, no vote. A bill this stuck deserves a definition. What does it actually say? It's a lot to take in, so feel free to download the entire research linked in the description below. In plain English, Clarity is a rulebook saying which US regulator runs which token and what an exchange must do to list it legally. 5 terms carry the story. A digital commodity, a token on a sufficiently decentralized network, goes to the CFTC. The decentralization test decides which regulator you answer to. Stablecoin rewards, payments to holders of dollar tokens, are the bank's red line. Section 604's developer protections are law enforcement's. Those 2 red lines are why the bill is stuck, and how it got stuck is a story told in 6 dates, including one betrayal. July 2025. The House passes it 294 to 134, a 160-vote margin the Senate has never matched, and the Genius Stablecoin Act becomes law. January 2026 brings the twist. Coinbase, the biggest US exchange, pulls its endorsement, arguing a flawed bill is worse than none. The industry splitting against itself. May, Senate banking advances it 15 to 9. Both Democratic yeses attaching caveats. The 1st of June. It lands on the calendar as Order Number 423 and sits. A 616-page merged text dropped on the 22nd of July. The 7 negotiating Democrats still call it short. The politics are messy. The numbers underneath are brutally clean. The red first, total market cap $2.27 trillion, down 42% in a year, 47% off the October peak. Coinbase revenue down 31%, trading volume literally halved. Adjusted EBITDA down 67%. The green USDC circulation up 28% to $77 billion. On-chain volume up 263% to $21.5 trillion. Coinbase's trading share a record 8.6%, 5 times 3 years ago. And the line that should worry you most, the CFTC, the agency this bill crowns, lost 21.5% of its staff in a year and runs a budget 5.9 times smaller than the SEC's. So with prices falling everywhere, what's actually still growing? Strip out token prices and one engine keeps running. The dollar tokenized. USDC supply grew 28%, but the volume moving across it grew 263%. The same dollar's turning 9 times faster. Utility, not speculation. Coinbase's record share came in a quarter. Industry volume fell 28%. Durable, but share gains inside a shrinking pie. Newer products like prediction markets are early and small. Circle's income is a rates business, and token prices are pure beta. Beta being the slice of return that's just the market moving, not the business. Now follow the money down the chain. One number deserves a screenshot. Think of a stablecoin issuer as the world's dullest bank. You hand Circle $1, it hands you a USDC token, parks your dollar in short-dated treasuries, and keeps the interest. Revenue is float times rate, $77 billion at 3.5%, produced $653 million last quarter, 94% of everything Circle makes. The screenshot line, Circle carries the balance sheet risk and regulatory burden, then pays roughly $908 million a year to Coinbase for distribution, about 35% of its annualized reserve income handed to the shop window. That contract's initial term ends on the 18th of August. Keep that date loaded. Next, we rank exactly who's getting paid. Rank the pools and the picture sharpens. Coinbase trading is still biggest at $756 million, but it fell 23% in a single quarter, the most cyclical dollar in the chain. Subscriptions and services hit $584 million, 44% of net revenue. The toll booth, recurring fees collected whether markets rise or fall, the opposite of casino-style trading income. The quiet winner? Add Coinbase's $305 million of stablecoin revenue to Circle's $653 million, $958 million a quarter earned from dollars sitting still. So if that's where the money lives, how would you actually own some? Ranked by purity, there are 2 pure plays. Circle, where essentially 100% of revenue rides on this theme, and Coinbase, the largest US venue and custodian to most Bitcoin ETFs. Everything else is optionality. BlackRock sponsors the biggest ETF and manages Circle's reserves while backing its new competitor. And Goldman's CEO endorsed the bill on the 23rd of July, publicly breaking with Jamie Dimon. The losers matter. Deposit-funded banks fighting stablecoin rewards of 3 to 5% that undercut savings accounts, and Circle's own margin down 17% the day the Open USD consortium appeared. Follow the capital itself, though, and it tells a strangely two-sided story. Is capital arriving or leaving? Both. And the split is the tell. 2026 is the first negative flow year since spot Bitcoin ETFs launched, minus $5.4 billion so far, with June's $4.5 billion the worst month on record. Yet Circle just raised $222 million and won its OCC bank charter. Coinbase bought back $1.1 billion of stock, while 1,200 tech companies plus 382,000 police officers pressed the Senate to move. Capital is leaving the beta and arriving at the infrastructure. That looks like a cycle near its trough. The unit economics will tell us. Now the maths, derived, not asserted. Circle's reserve rate is 3.5%, down 66 basis points, a basis point being 1/100%. At a $77 billion float, every 100 basis points of Fed cuts costs $770 million of annualized revenue. Circle needs about 19% float growth a year just to stand still, versus a stated 40% target. Coinbase teaches the other lesson. Its EBITDA margin collapsed from 45.8% to 21.5%. Operating leverage in action. Fixed costs make profits soar when revenue rises and crater when it falls. And every one of those levers has a date attached in Washington. 6 decisions, all dated, all two-sided. Cloture hasn't even been filed. Recess starts on the 8th of August. The ethics package bars the president, vice president, Congress, and federal judges from issuing or holding crypto in office. The 7 negotiating Democrats still say it falls short. Tillis also Brooks bans passive stablecoin yield but permits activity-based rewards. Goldman can live with it. The American Bankers Association calls it evasion. One win. The Fraternal Order of Police endorsed the revised text, and the Fed meets on the 28th and 29th of July, Circle's revenue line in its hands. So the only question left is the market's favorite. What's already in the price? Mostly failure. Watch the odds line. 82% in February, 74% when banking cleared it, 47% in June, 24% by mid-July, then a bounce to 37% on the merged text. Quick decoder. Implied odds are prices. A contract costing 37 cents that pays $1 on passage means the crowd says 37%. Galaxy is gloomier still at 30%. Meanwhile, Citi cut Coinbase from $400 to $235, a 41% haircut, and Bitcoin sits at $64,290 with sentiment deep in fear. The bad news has been thoroughly marked. What hasn't been marked is the branch where it passes. Time to argue both sides. 3 arguments for the bull. 1. The infrastructure earns in a bear market. Coinbase posted $584 million of subscription revenue and a 13th straight positive adjusted EBITDA quarter, despite a $394 million paper loss. And Circle grew revenue 20% through a 45% drawdown. 2. Utility is decoupling from price. Settlement volume up 263% against supply up 28%. 3. The sharpest. Success isn't priced. The House already passed this 294 to 134 and promises to move fast. At 37% odds, the yes branch faces a gloriously low bar, persuasive, which is exactly why the bear deserves its best lawyer. Time to Steelman the bear. Steelmaning meaning you argue the strongest version, not the easiest. 1. The bill can pass and still fail. It hands a $2.27 trillion market to an agency with 556 staff, 1 commissioner of 5, and an inspector general calling this its top risk. 2. The economics are a rates bet wearing a crypto badge. 94% of Circle's revenue moves with the Fed, not the bill. 3. The killer. Coinbase, Circle's most important partner, just joined the 140-member consortium, building its replacement 3 weeks before the contract renews. Both cases down. Now let's test the 5 claims everyone repeats. Claim 1. The bill needs 7 Democrats. False, it needs 10. Claim 2. The industry is united. False, Coinbase pulled its own endorsement and Cardano's founder sided with Senator Warren. Claim 3. Wall Street is against it. It depends. The split runs along funding models. Goldman's CEO backs it, JP Morgan's opposes it, deposit-funded banks hate the rewards clause. Claim 4. Passage is the bullish catalyst. Only if a 556-person agency can write the rules. Claim 5. The recess deadline is real. Practically, yes, September belongs to funding fights. Now for the 8 things the headlines will skip entirely. Start with the biggest. The $908 million Circle Coinbase deal ends its initial term 10 days after the Senate leaves, and Coinbase reportedly holds veto rights over Circle's new partnerships from inside the rival consortium. Circle, meanwhile, built its own moat. OCC Trust Bank approval landed on the 10th of July, clarity or not. Kalshi traded roughly $111 billion in half a year, over 80% sports, policed by the same threadbare CFTC. And the extra $150 million Congress authorized isn't money yet. Authorization is the promise, appropriation is the check, and only the check counts. Speaking of dates, look how much lands inside 3 weeks. Everything dated, ranked by impact. The Fed meets on the 28th and 29th of July and directly sets Circle's revenue line. The 30th is a double-header, Galaxy's estimated last workable day for a deal, and Coinbase's second quarter results after the close. Circle reports on the 5th of August. The Senate leaves on the 8th. The contract expires on the 18th. OpenUSD goes live in the second half, and the 3rd of November midterms set the arithmetic for any 2027 rematch. 4 of this theme's 5 biggest events land inside 20 days, and every single one of them feeds the same chart. If you track one chart from this video, make it this one. The bottom bar is the world everyone assumes. 53 Republicans, 7 Democrats needed. The top bar is the world Galaxy describes. 50 Republicans, 10 Democrats needed. Here's the cruelty. 3 missing Republican votes don't cost 3 votes. They cost 3 extra Democrats. From a caucus where only 7 are negotiating and 3 have declared against. That, in one picture, is why the odds fell from 82% to 37% without a vote cast. Turn that arithmetic into forecasts and you get 4 scenarios, probabilities included. 4 scenarios, probabilities anchored to market pricing. Bull, 30%. An ethics deal by the 30th, cloture cleared, the house moves fast, and a catalyst the market had 63% discounted reverses the derating. Base, 50%, where we land. No floor vote before the 8th of August. The bill slips, and earnings and rates do the work. Bear, 15%. Talks collapse into a watered-down rider on a must-pass vehicle. And a 5% wildcard. It passes. A one-commissioner CFTC can't deliver. The signature rallies the theme. The delivery disappoints it. Blend those branches and you get our score, built to be argued with. Here's how the 5.2 was built, pillar by pillar, so you can disagree properly. Structural demand scores 6.5. The volume growth is real, but it lives inside a market down 42%. Economics, 6. Genuine sourced profit pools leaning too hard on interest rates. Capital flows, 3. The first negative ETF year ever. Valuation, 7. Failure discounted, success not. Policy, 3.5, because the majority leader says it won't pass before recess. Weighted, 5.45. Subtract 0.3 for a binary vote on a hard deadline. 5.2 out of 10. A score is a snapshot though. What you need is the watch list. The watch list, every cue paired with the level that proves you wrong. The highest information event, a cloture motion filed before the 7th of August, invalidated the moment the Senate leaves without one. Watch 3 of the 7 negotiators commit publicly and Polymarket holding above 60% for 5+ sessions, not one headline spike. Watch whether USDC float grows faster than the reserve rate falls, the core bull mechanic, and the terms of that 18th of August renewal. To be clear, these are frames for reading evidence, never recommendations to buy or sell anything, which brings us to the bottom line. It fits in one sentence. Here's that sentence. A good business story trapped inside a bad legislative one. The toll booths collected $958 million last quarter, whether Washington moved or not. If you like them for the tolls. The bill is a 30% proposition, and our 50% base case says the Senate leaves on the 8th of August without voting. What isn't in the price is the version where 10 Democrats materialize within a fortnight. One note, this is research and education, not personalized advice. Figures are as of the 26th of July, 2026, so verify live data and speak to a professional about your situation. Today, you got the honest version. A 5.2, not a 10, a steel-manned bear, a bull case we refuse to inflate because that's how we do this. At Wall Street Holic, we ignore the hype and are transparent about what we know, what we don't, and where the evidence leads. Don't forget to download your copy of the full research in this video using the link in the description below. If you want to cut through the noise, hit subscribe, give the video a like, and share it with others. This is a subscriber-led channel, so the more requests we receive, the more in-depth research and deep dives we bring to you. See you in the next video.
This video is for entertainment only, reflects the creator's opinions, may include stocks they own, and is not financial advice.